On this channel, we spend a lot of time talking about strategy and different exits and building long term wealth. But one of the questions I hear constantly from business owners is how do I actually know if my financials are working for me or just keeping up with me? That's exactly what we're digging into today. I'm going to hand things over to someone who lives and breathes this every single day. I'm David Stevens with Stevens Capital Partners. Over the next few episodes, we're bringing in one of our own, someone whose expertise goes deeper than any topic I could cover alone. Terrence Hutchins is our Managing Director of Tax and Business Planning here at Stevens Capital Partners. Terrence works directly with business owners on some of the most complex tax strategies, from business structure to deal architecture when getting a business ready for whatever comes next. We're doing 3 episodes together focused specifically on tax and business planning, and this is the first one. The topic today, CFO services, what they actually are, why they matter, and why most growing businesses need them a lot sooner than they think. Terrence, I'll let you take it from here.
Thanks, David. Now, most business owners I work with are profitable. They're generating real revenue, they've started to build a team, and they've built something that they know is meaningful. But here's what I see constantly. Those same businesses are one bad quarter away from being completely out of control. Maybe it's an unexpected tax bill, an employee gives their 2 weeks notice. Now we know business is unpredictable, and unpredictable can be expensive. So today, I want to talk to you about what it actually looks like to build a financial structure into a growing business, and why the role of CFO isn't just about the numbers. It's about building something that you can run, grow, and eventually transfer without falling apart. I'm Terrence Hutchins, Managing Director of Tax and Business Planning at Stevens Capital Partners. In my work with growing companies, I see the pattern over and over. I see great operators who are very smart, they've built traction in their business, but the financial foundation hasn't kept pace with the business. You know, that spreadsheet you pull out to cobble together your numbers at tax time? And oftentimes, that approach to finance creates a gap that will give you an invisible ceiling in the business. And you can only grow as fast as your financial clarity allows. So what we're going to cover today maps directly to 3 things I see holding businesses back. Number 1, most businesses are profitable, but they're fragile, and there's a specific reason why. Second, real CFO work isn't bookkeeping. It's building what I call financial architecture, and there's a meaningful difference. And third, exit planning isn't something you do at the end. It's actually just good business planning, and it starts right now. So let's get into it. So first, most businesses are profitable, but they're fragile. Now here's something I tell business owners all the time. Profitable doesn't mean predictable, and unpredictable is expensive. And so even though you're generating real revenue, you may even have happy clients, and your top line looks great, and still you could be one bad quarter away from feeling completely out of control. I've seen it happen over and over. And the reason isn't the market, it's not necessarily your product, and it may not even be your team. It's that nobody ever built a real financial structure underneath the business. Here's a stat I want you to sit with. 82% of businesses that fail, they fail because of poor cash management. They didn't just shut down their doors, they really ran out of money. They could have been in a bad market, they could have had poor cash flow at certain times, and that eventually caused the business to crumble. And when I share that with clients, you know what they say? Well, my business is profitable. That's not really me. However, that could be part of the problem. Now, here's what most business owners don't realize. Profit and cash flow are 2 completely different conversations. Your P&L can look great, but your bank account can tell a different story. If you don't understand why that gap exists, you're just reacting to every month instead of managing it. So think of it as this. There's really only 5 places your profit can go. So first, you have your great uncle, Sam, where taxes are always going to be there every year, whether planned or not. You also have debt. Thirdly, it can go to reinvesting back into the business, and that's what is going to allow you to grow the company. You can retain the money in the business for a rainy day or for future investment down the line, which I always encourage business owners to maintain at least 2 months of operating capital so that they can plan for something unexpected. And then lastly, you can distribute any free cash to yourself. Now, every dollar of profit you make is going to one of those 5 places. The question is, are you deciding where it goes or just finding out after the fact? Now, most business owners I work with have never actually mapped that out. So every month feels like starting over. They could even be making hiring decisions, pricing decisions, capital decisions without a real forecast in front of them. That's like driving, but only looking through the rearview mirror. Now, once you've got a real 12-month rolling forecast in place, once the owner can see 90 days out instead of just reacting to the last week, the business doesn't just grow, it becomes predictable. Now, I want to be clear about something. The goal isn't just growth. The goal is to build something that doesn't fall apart if you step away from it. Right now, too many businesses have the owner as the only person who truly understands the financial picture. That works until it doesn't. Until you want to take a real vacation, you want to bring in a partner, or eventually sell. So ask yourself right now, if you stepped away from your business for 30 days, would your business have the financial visibility it needs to keep running without you? If the answer is no, then that's the gap we need to close. So secondly, a real CFO builds financial architecture, not just reports. So what I'm describing is not bookkeeping, all right? I want to make sure that you make that distinction because a lot of business owners confuse the two. Bookkeeping tells you what happened. What I'm talking about is what's going to help you determine what will happen, why it's happening, and what you should do about it. Those are completely different conversations. Now, one thing I harp on constantly with business owners is they need to be reviewing their financials on what I call a rolling 3 or rolling 13th month basis. So rolling 3 just gives you a recent trend. Let's look at the last 90 days and compare that to the previous 90 days before that. A rolling 13 helps you compare this month to the same month last year, so you can actually see if the business is growing or just repeating the same seasonal patterns. Most business owners are only looking at year to date, which honestly doesn't tell you very much. And only about 40% of business owners actually look at their financials on a monthly basis. That means the majority of business owners are making major decisions without regular financial feedback. That's the equivalent of getting a doctor's report once a year and automatically thinking you're healthy. Now, when I'm doing real CFO level work with the business, and most business owners, honestly, they don't like numbers, but I at least want them to pay attention to what I call the core 4. So these 4 things are revenue, or what comes in the door, gross profit, and what you actually make after your direct cost of delivering your product or service. You have your net operating income, which is what's left after you pay all of your overhead, and then your cash, because that's what actually keeps the lights on, regardless of what the P&L says. So these 4 numbers, if they're tracked constantly on a rolling basis, will tell you more about the health of your business than anything else. But here's where you can go even deeper than that. Part of what I assess when I'm working with the business is what is this business actually constrained by? Because that changes everything about where you should be putting your money. Is your business supply constrained, meaning you have more demand than you can actually deliver on, and you need greater capacity? You need more people, you might need more equipment. Or are you demand constrained, meaning you don't have enough customers coming through the door, and so you need extra marketing assistance, or you might need more sales infrastructure. Most business owners are reinvesting money in the wrong place because they never answered that question. And so when we're talking about reinvesting back into the business, because that's one of the 5 places your money can go, I have a hard and fast rule, which is a minimum of a 50% return on invested capital within 12 to 24 months. So in layman's terms, that means for every dollar you reinvest back into the business, that dollar needs to bring back at least $1.50 in profit within 2 years. If it can't, then it's not a good investment. Now, I don't care how it sounds on paper. Don't spend $1 to make back 40 cents. So when I'm working with clients at this level, we're also watching key performance indicators, or KPIs for short, that go beyond just the income statement. So you should be tracking things like your labor efficiency ratio, which is essentially the amount of revenue you spend per employee, because that tells you whether your people are actually generating a return. You also have your customer acquisition cost, which are what you actually spend to bring in a new customer, as well as the lifetime customer value, which is how much that customer is worth to you over the full life cycle of your relationship. So when you know your customer acquisition cost and your lifetime customer value, you can make smart decisions about how much to invest in the growth. When you don't know those numbers, you're just guessing. So I had a client, they had very solid and consistent revenue, great top line, as you'd call it, but their cash flow was all over the place. Some months felt fine, others felt like a crisis. But when we dug in, the issue wasn't the revenue, it was the structure, the timing of their receivables, their working capital cycle, how expenses were categorized. Nothing wrong with the business itself, everything wrong with how the capital was being managed in the business. So once we cleaned that up, we got intentional about how money was moving through the business and put the right metrics in front of them. They didn't need more revenue, they needed better structure. And when we did that, their cash flow started to stabilize, the stress came way down, and they finally had the bandwidth to think about where the business was going instead of just surviving month over month. And that's what real financial architecture looks like. It makes your business predictable, scalable, and decision ready. It means you're not just tracking what happened, you're managing what's coming. So here's what you should do. Pull your last 3 months of financials right now and ask yourself, do these 4 numbers, the core 4, tell me what I need to make a good decision next quarter? Am I looking at my revenue, my gross profit, my net income, and my cash? Now, if you can't answer that with confidence on how you might think things would go in the future, then that's exactly a conversation we need to have. Now, thirdly, exit planning is really just good business planning. This is the point I want to spend a little extra time on because it's the most misunderstood of the 3. When most business owners hear exit planning, they immediately think you're selling next year. Or, hey, I'm not ready to get out of the business. What am I going to go do? And they actually think it's only relevant to think about the exit when they're ready to walk out the door. Now, neither of those is actually true. And that misunderstanding is actually costing people money right now, whether they sell today or not. Now, research shows that 80 to 90% of your business is actually tied to what are intangible factors. These could be things like systems, processes, customer relationships, and most importantly, whether the business can run independently of you, the founder. That means the majority of what your business is worth has nothing to do with last month's revenue. It has everything to do with whether the business can run without you being there every day. So the question isn't, when do I start exit planning? The real question is my business actually building that kind of value right now, or am I just building a job for myself? Now, there's nothing wrong with building a job for yourself, but you got to know that there's no tangible value to an outside buyer in that situation. In fact, an outside buyer is going to look at really 8 components of your business. So you have finance, your product or service, HR, sales, marketing, IT, customer service, and recruiting. Now, when I look at things through a CFO lens, I'm specifically thinking about 4 of those, which are going to be finance, product and service, sales, and marketing. Generally, most of the business value is going to be created in those 4 categories. And that's where most of your risk lives if you don't have a solid plan for each. So for every one of those components, I'm asking 3 main questions. Number 1, is there a clear process? Number 2, does that process work consistently? And number 3, can it run without you, the founder, being involved? That last question is what separates a valuable business from an expensive job. Because think about it. If your sales process only works because you personally are the one making the calls, that's not a sales process. That's just you. If your financial reporting only happens because you're the one pulling it together every month, that's not a system. That's dependency. And dependency is the number one thing that kills business value. Now, I had a client who came to us wanting to grow their valuation because they were looking to eventually exit. Now, the first instinct, like most business owners, is they were thinking, okay, how do I grow my revenue? I need to build my top line. Now, that potentially will help, but that's not always the first thing you need to solve. So when we actually looked at the business through a buyer's lens, the biggest risk wasn't actually a revenue gap. There was a lot of dependency risk. Many of the key relationships, a lot of the knowledge of how the business runs and functions, many of the key decisions, all of it ran through one person, the owner. So instead of just chasing top-line growth, we had to take a step back and focus on reducing the dependency of the business on the owner. So we had to work on building systems really in those 4 components I mentioned. So we had to structure the financial reporting so it didn't require the owner to assemble it. We had to document processes in sales and marketing so someone else could run them. And the valuation was able to improve. Not because revenue went up, but because the risk profile of the business went down. The business became something a buyer or a successor or one of the leadership team members could actually come in, step in, and take over for the founder, and everything could run smoothly. So that's why I always come back to the fact that you don't have to be thinking about selling the business to benefit from this. A business that's predictable, transferable, and not dependent on you is just a better business to own. It's less stressful, It gives you more options. If the day comes where you do want to sell, bring in a partner, or just take a step back, you're not scrambling to make it work. You've already built the business that way. The most valuable businesses are the ones that don't need you there every day to run and function. That is the goal. And that's what real exit planning actually looks like. So how about you go through your 4 components of your business? As I mentioned, finance, sales, marketing, and product or service. For each one, ask yourself, is there a clear process here? Does it work consistently? And can it run and possibly even grow without you being involved? Where your answer is no, that is going to be your starting point. So let's bring this all together. Most businesses are profitable, but they're fragile. And the gap is almost always in the financial structure, not the revenue. You need to know where every dollar of profit is going across those 5 places, as far as reinvesting, debt, taxes, retaining, and distributions. You need to have a real 12-month forecast in front of you so you're driving forward instead of looking in the rearview mirror. As real CFO work isn't just about generating reports, it's about building the financial infrastructure that makes the business predictable, scalable, and decision ready. That means tracking your core 4, revenue, gross profit, net profit, and cash on a rolling basis, understanding whether you're supply constrained or demand constrained, and making sure that every reinvestment clears that 50% return threshold before you commit to it. And exit planning isn't a future problem, it's a present discipline. The most valuable business is the one that can run without you being involved. And building it that way makes it better right now, whether you ever sell or not. So remember these 3 questions. Number 1, does my business have the financial visibility to run without me for 30 days? Second, are my core 4 numbers telling me what I need to make a good decision next quarter? And third, when I look at my 4 key business components, finance, sales, marketing, and product, can I honestly say each one has a clear process, works consistently, and can run without me? When the answer is no, that's exactly where you need to start. So if any of this resonated with you, or if you want to talk through what CFO-level services might look like for your specific business, reach out to us at Stevens Capital Partners. This is exactly the kind of work we do every day with business owners who are serious about building something that lasts and that actually works without them having to be involved on a day-to-day basis.
Terrence, thank you. This is exactly the kind of conversation I wanted to bring to this channel. Practical, honest, and directly applicable to what business owners are navigating right now. We'll have 2 more episodes with Terrence coming up, so make sure you subscribe so you don't miss any of them. I'm David Stevens with Stevens Capital Partners. We'll see you next time.